I welcome you to this edition of our training concerning the proposed bill at the National Assembly. We promise you that we will not keep you in the dark. As the foremost tax professional institute in the country, we owe you the obligation to make sure that we give you all the information that will make you to thrive. I am happy to say that this is the best time to be a tax professional in the country. A lot of things are coming up, and very soon, apart from corporate entity having tax consultant, I know individual will also be requiring the services of a tax consultant. But all these opportunities that are coming will only be available for those who have the competence. And as your institute, we owe you the obligation to make sure that we keep you up to date.
Beginning from Monday, 24th February 2025, the two chambers of Nigeria National Assembly commenced public hearing as part of the process of passing into law the 4 tax reform bills submitted to the National Assembly by the executive arm. Among the 4 bills is the Nigeria Tax Bill 2024, which, among other things, seeks to amend the Petroleum Profits Tax Act, Cap P13, LFN 2004. The Petroleum Industry Act 2021, as well as introducing a hydrocarbon tax. For more than 60 years, oil, crude petroleum has been the mainstay of the Nigerian economy, contributing a major chunk of tax revenue. In spite of the overarching importance, not much is known by the general populace about the taxation of the petroleum sector.
As you will know, not all of us have very much to do with petroleum tax. So a lot of people skip over the full details there.
I'm welcoming you all to this webinar, the 4th in the series. We've done 3 editions in the course of November and December last year. And this very edition is highly technical. We are analyzing the intricacy of taxation of income from petroleum operations under the proposed Nigeria Tax Bill 2024. We want to ensure that our members and stakeholders are attuned with the provisions of those tax laws so that when it is passed, you'll be able to relate with them accordingly. It is very important that I give a preview of today's topic. The bill in question is in Chapter 3 of the Nigerian Tax Bill, and during my research, I realized that the section of that bill contains 53 sections, which our lead presenter will be doing justice to, and it contains also 4 parts. It means there's a lot of issues in the taxation of income from petroleum operation to have almost 54 to 55 sections, which our paper presenter will be dealing with.
The topic today is the economic stabilization bills, the analysis of the intricacies. It's a very key word of the taxation of income from petroleum operations. Now, as you will know, not all of us have very much to do with petroleum tax. So a lot of people skip over the full details there. However, a lot of the principles are very, very peculiar. The bill is introducing a hydrocarbon tax, which is levied on revenues generated from crude oil production. It's changing some of the deductions under the allowable deductions. There's consolidation of the laws into a single simplified law, and that includes the repeal of the PPTA, the Petroleum Profits Tax, and integration of its provisions into the new tax framework. That in itself is a Herculean task. And of course, revenue collection now specifically tasks the Nigerian Revenue Service with responsibility for all of the collections. It's going to have a massive impact on the petroleum industry. Companies and those of us who advise companies are going to need to adapt to the new structure. and ensure compliance with the updated regulations. And this may involve going right back and revisiting your entire financial strategies and accounting practices. And Alhaji Aziz will bring out some of these in the excellent examples he has to walk through with us in this, as Dr. Ade said, a very technical session. As you can imagine, there are interactions with the existing Petroleum Industry Act, which in itself took a long time to birth. So apart from the consolidation of laws and the repeal of the PPT, there are still some areas of overlap which will need to be carefully worked through and fully understood. There are some few amendments of the Petroleum Industry Act itself, targeting parts 1 to 4 of Chapter 4 and the 5th and 6th schedule and so on. These amendments may create some element of inconsistency, which we, FIRS and colleagues, will need to work through and make sure that this doesn't impact negatively on the business.
I will yield the floor open to Alhaji to take the proceedings in the next 45 minutes. Alhaji, you have the floor.
I welcome all the distinguished members of our great institute to this technical session, which is analyzing the intricacy of taxation of income from petroleum operations under the Nigeria Tax Bill 2024. The expectation is that at the end of this session, the participants are expected to broaden, their horizon on general overview of taxation of income from petroleum operations under the Nigerian Tax Bill. So today we are going to be focusing on Chapter 3 of the Nigerian Tax Bill. Chapter 3 actually has 4 parts, and we will be looking, at part 1. Of those 4 parts, which has to do with the hydrocarbon tax. Part 2 has to do with the petroleum profit tax, because there is still grandfathering, for those who are still under the PPTA or Petroleum Profit Tax Act. That has been technically abolished, but however, is still on because of fiscal stabilization. So it's still there. So we look at Chapter 3 as well, deal with the deep offshore inland basin production sharing contracts. Then we'll be looking at the miscellaneous, sections where you have the definition of some terminologies, which is the part 4 of Chapter 3. So we will be analyzing the tax law, to cover ascertainment of chargeable tax under hydrocarbon tax, ascertainment of chargeable profits under hydrocarbon tax, consolidation, for tax purposes under hydrocarbon tax, imposition of tax and ascertainment of chargeable profits under petroleum profit tax, as I did mention, and ascertainment of accessible profits under petroleum profit tax, etc. As much as time, can permit us. I know some people who are experts in the operations of, petroleum activities. They will wonder why this topic has been arranged in this order. How do you do ascertainment of chargeable tax, under hydrocarbon tax? Then you then come to ascertainment of chargeable profit. We think profit comes before, tax. So those are some of the new learnings that we need to look at when you are looking at Section 65, of the Nigerian Tax Bill. The third thing we will be looking at is the importance of tax audit, in oil and gas industry, as well as its administration, broadly. Let's move into the learning objectives. And the first actually is to gain a clear understanding of the legislative and then regulatory background governing taxation of petroleum operations in Nigeria under the 2024 Economic Stabilization Bill. As I have mentioned to us, the focus today is really for us to understand Chapter 3 of the Nigerian tax bill. As of this morning, I'm aware that this bill has already passed, the second stage, and is now at the committee level. So I believe we will all have, opportunities for, public hearing in respect of this. But I'm not expecting a significant change from what we already have right now. So this session is supposed to give us, some background to the legislative profession. So what we are doing this morning is more like a taxation in advance. But I know quite a number of us are very familiar with the Petroleum Industry Act. For instance, that is what we are already using to do tax filing. So most of the sections extracted here for ease of reference, based on what was actually adopted in this Nigerian tax bill, more of the part 4, of the PIA, which is the fiscal, section of that act. So the second is to explore fundamental, principles of hydrocarbon tax and petroleum profit tax, to appreciate how chargeable tax and then chargeable profit are determined in the oil and gas, sector. Learn practical steps on the calculations for ascertaining chargeable and accessible profits under the hydrocarbon tax and then petroleum profit tax. Meanwhile, the PPT is still in existence by those who are yet to convert, from PPT to PIA. So the last is to formulate, tax planning and then compliance strategies that align with the provisions of the 2024, bill. Now, the word formulate tax planning will run riot in the head of so many Nigerians by the time they are hearing it this morning. I think one of the words that FIRS is so much afraid of is the word tax planning. The moment you hear the word tax planning, no, it's tax planning, no, we have to counter that tax planning, and so on and so forth. But I think this learning objective has defined tax planning within the scope that the Institute is expecting. And tax planning is compliance strategies to avoid penalties and interest. That's what we are saying. For instance, you have to pay your hydrocarbon tax or your PPT, within 5 months of the year, you have to file your tax returns. You must plan to file your return within 5 months. If you do so on the 6th month, it means you are non-compliance. So you must plan to comply. He who fails to plans to fail. That is the idea. So I've always been discussing with my brothers and sisters in FIRS that, look, tax planning is the excellent thing that can happen to tax administrators, tax practitioners, and the taxpayers. You have to plan to make sure that you act within the law. I know that the Institute has a standard, on tax planning, which is a standard number 9, and this standard actually explains to us in details, what tax planning is all about. It comprises of the definition of, tax evasion, which is totally unacceptable, tax avoidance, which is now being detested, aggressive tax avoidance also, which is not, acceptable. You talk about tax morality, yes, there is no morality in law, but that is the persuasive direction the world is really going. So all these things are in that taxation standard number 9, so which is going to explain this bullet point number 4 in terms of, formulate tax planning and compliance strategies. So what the Institute is looking at is, what is your compliance strategies that you are planning for? I know the FIRS also plan for its revenue. So we cannot say revenue planning is, is something negative. No. So planning is about really compliance. I must emphasize that in line with the Nigerian tax bill 2024. So this is like taxation in advance, if I may put it that way. I don't want to use advanced taxation, but rather taxation in advance. So we have to all be looking, forward to what is the National Assembly going to pass about what we are discussing, this morning. I'm going to heavily rely on the existing PIA, and link it to the, incoming Nigerian, Tax Act, now bill, so that we will have, a direction of where we are coming from PPT now to hydrocarbon tax, from hydrocarbon tax, we now have a hydrocarbon tax bill now becoming, an act. We already have hydrocarbon tax under the PIA, by the way. So, but again, we are going to migrate into the second phase of the hydrocarbon tax, which is now going to be a new law when it is passed, into an act.
Unlock the future of taxation. Join the most anticipated event in the tax calendar, the 27th Annual Tax Conference. Experience the ultimate blend of learning, networking, and celebration. This is your chance to gain insights from industry experts and thought leaders, to shape the future of taxation with policymakers and influencers, to connect with fellow professionals and expand your network, and to enjoy unforgettable gala nights, thrilling sport events, and many more. Theme is Taxation for Development, Policies, Law and Implementation. Date is May 12th to May 16th, 2025 at the Abuja Chambers of Commerce and Industry. Don't miss this opportunity to enhance your professional skills and knowledge, influence tax policies, and shape the future of taxation. Build lasting relationships with fellow professionals. Secure your spots now and be part of this milestone event. To register, please visit www.citnevent.org/events. We look forward to seeing you there.
So let's go to the general overview of taxation of income from petroleum operations. Let me tell us one of the good things about the Nigerian Tax Bill 2024 is that it tried to consolidate, taxation of all income into this act. Personal income tax, companies income tax, you find all those in chapter 2. Then when you move to chapter 3, then you find the taxation of petroleum operations. So, I know quite a number of us, if we don't read these slides, of course, we won't have time to do that. We'll put it by the side. So we'll go as much as possible to read, and then I explain. So the Economic Stabilization Bill 2024, introduced as part of Nigerians' broader fiscal reforms, aim to address revenue challenges and then stabilize the economy amidst fluctuating, global oil prices. A key component of the bill is the adjustment of the tax structures for petroleum operations to align, with the Petroleum Industry Act, PIA 2021. So we know that it took Nigeria 20 years before we can pass this Petroleum Industry Act, 2021, the journey that started year 2000 until 2021 before it became, an act. It's always argument, all over on almost every sections of the act until the government said, no, okay, now we have to pass this thing. And then at the government level, I have to pass that act. So in Nigeria, taxation of income from petroleum operations is governed primarily by the Petroleum Profit Tax Act, as I said, from 1959 down to 2021. We also have the Deep Offshore Inland Basin Production Sharing Contract, started from 1999, and also to date. And then finally, the Petroleum Industry Act, which is 2021, and now that try to be the way forward. And I said, why the PPTA historically imposed a single tax, on profit derived from petroleum operations, The PIA introduced a dual tax structure, which is hydrocarbon tax plus companies' income tax. We have a CIT and then modernized several legacy provisions. So this is one of the major differences between petroleum profit tax and the hydrocarbon tax plus CIT. So on one hand, what we were having from 1959 to 2021 was only one tax, which is petroleum profit tax under the Petroleum Profit Tax Act. And then now what we are having going forward is hydrocarbon tax plus the company's income tax. So that is what we are having right now that we are trying to explain. Now, let me say that one of the major challenges that we've been having, and one of the arguments that delayed even the passing of the PIA was whether Nigeria should have a single tax regime or a dual tax regime. So it's one of the major debates in the argument. And some are of the opinion that there should be only single tax regime because we have so long list of taxes. And because taxation of a petroleum industry is about, okay, you have $77 US per barrel, it's just only, one. And so if government want to take certain, percentage, let it take it once. So why are you taking under one and then taking another one? However, the other argument is that no, let those who are in upstream first pay hydrocarbon tax because that is an economic rent tax. So let that be done. I know the academicians are very, very happy, with this. And then they will say all companies now pay CIT in Nigeria. So that comes under like they put everyone on the same platform, and that's exactly so what we are looking at here, which is now the way forward, that all companies, even those who are under hydrocarbon tax, now have to pay CIT. So I will not go so much into that argument of multiplicity of taxes and this and that. Those are academic discussions, also affect our practical, performances. So now let's move into the technical aspects a little bit, and I'm going to try to explain, what that is in a simpler form. On the ascertainment of a chargeable profit, under hydrocarbon tax, let me just recap, a little bit to say that the PIA of 2021 introduced the hydrocarbon tax as a key component of the fiscal framework for upstream petroleum operations. The hydrocarbon tax, specifically applies to crude oil production from onshore and shallow waters fields. I think we need to note that the provisions governing the ascertainment of chargeable profit and chargeable tax under the hydrocarbon tax are found, in section 260 and 275 of the PIA, which is the existing PIA, which is now section 65, starting from section 65 of the Nigerian tax bill. So whatever you find in section 260 to 275, you will find it in section 65, of the of the Nigerian tax bill to section 88. So that's what you will find there. But it actually runs to section 118, to cover both the PPTA as well as the deep offshore inland basin production sharing contract, as well as the miscellaneous, provisions. So it is good to place this on record. So the scope of hydrocarbon, as we have it, it applies exclusively to the crude oil as well as the field condensates and then liquid natural gas liquids, derived from associated gas produced in the field upstream, of the measurement point production from onshore and shallow water fields. So these are the two fields as we find, as we move forward. Now, let's move on to determination of chargeable profit and chargeable tax, now. So the first one is determination of revenue, and the gross revenue include the total income, from crude oil sales and then incidental, earnings to the crude oil sales. Basically, this is, I think, simple and straightforward. The first one is proceeds from the chargeable oil sales. There are two aspects to this. As I said, I'm going to try to simplify it. We will leave the technical aspect, of measurement at the measurement point between the oil, companies as well as the NUPRC in terms of measurement. There is not supposed to be any misunderstanding, in my honest view. For instance, the industries, they are working with best practices, and the government people are also working patriotically. So then, if we are measuring barrels of crude, I think we should arrive at the same number, at the measurement point. And also, once we know the price, of whatever it is, then we should be fine with what the value of that is. However, I am very mindful of quite a lot of, tricks here and there and the challenges that, we face. Now, when you measure this crude, there are two things, that is possible. The first one is the sale of this crude. And that is why I say your revenue is going to be sales. But what if you didn't sell it? You transfer it to the refinery, for example. You are disposing it and say, look, I don't have any price for it at that point. Are we going to wait for you until you process it and then you now, sell PMS, DPK, AGO, and all those kind of things before we get the revenue? No. The answer is simply no. And that is why the first part is talking about proceeds from the chargeable oil sales, where you sell it in crude and barrels to those who are going to refine it. If you are not a connected party, that is fine. However, you can also dispose those crude oil, and that is what the bullet point number 2 is talking about. Value of chargeable oil disposed. So you might actually dispose it, so maybe to a refinery or to petrochemical or whoever you dispose it of, or you even give it out, whatever that means. The value of it, the volume of that disposal is going to be taxed at the rate, the price which NUPRC is going to advise, as at that point. So I want us all to understand that whatever is produced is going to be, subject to tax. Now let's move on to allowable and non-allowable deductions. The section specifies the expenses that can be deducted, when calculating accessible, profit from hydrocarbon tax purposes. So key allowable deductions are reasonable expenses. Now, before, under the PPT, you won't have the word reasonable there. So we must note that this is one of the major differences as we move on. What we have under the PPT, that is Petroleum Profit Tax Act, is wholly, exclusively, and necessarily, which is when rule, not REN rule, which is under CETA. So to align the rule of the hydrocarbon tax now, because companies under hydrocarbon tax are now going to also be taxed under CETA. So therefore, that rule of REN is now introduced. So that is the logic, to that. Whether we are for or we are against, that is now the new law, because the rule of reasonability is a world on its own. Because whatever you do, it might be reasonable to you. For me, it might really not be reasonable. For instance, if an individual is going to an oil rig, for example, and we are foreseeing some security challenges, now we are giving only one individual form opposed so that that person is not picked, and then a huge ransom is going to. Now, if you look at the cost of form opposed following only one person, will you say that cost is reasonable? That's where the debate between the FIRS and then the taxpayers, come in. And this is where you need to sit down. Now the question is, the industry is going to be arguing, okay, if they kidnap this person and then we have to pay a huge amount, will it not be equal to the 4 people we are putting to, for him not to be kidnapped? And so by the time we do that, now we are charging this into our cost as an allowable cost. FRS is saying no, we see only one mopole being a very reasonable amount, and that is fine as far as we are concerned. Now these 3 people now we say, oh, is disallowed. So let us, let us take ourselves to tax appeal tribunal, and we keep on arguing and arguing and arguing. We remember the 4 argument of Shell, in 1973 as to whether commission, is allowable, whether scholarship is allowable, whether this, it took 20 years before the Supreme Court now said all those expenses claimed by Shell are all allowable, in 1993. 20 good years. So we want to avoid this thing as much as possible so that people can be doing their businesses, without necessarily having recourse to a dispute. So costs that are deemed reasonable and are wholly exclusive and necessarily incurred for upstream operations are what is allowable. And the Act introduced reasonableness criteria, though it does not explicitly define, what constitutes a reasonable expense. This is actually left at the discretion of the Federal Inland Revenue Service. And this is where sometimes, there are some issues here and there that takes us to tax appeal tribunal. If you ask me, these are some of the areas of improvement of even this draft bill, because we should define what we mean by, reasonableness with respect to each of those expenses so that the companies will know and know that this is disallowable. End of story. If it's not there, if you are talking about one mopo per one individual, whether it is reasonable or not, that action might not be reasonable because 2 people can actually be picked. And that's the point. But when there are many, so we need to sit down and still do more work on this bill with utmost, respect. But we need to pass and then move on. Then we talk about amendment. Contributions for commissioning and then abandonment, is another area which is already been improved now. Before, once you provide for these things, it's going to be disallowed, until you incur the expenses. But the new thing is that where this fund, is now set aside, as maybe approved by the commission, then this is going to be an allowable, expense. Another one allowed for hydrocarbon tax is royalties incurred, in kind, and payment made to the Federation accounts. They are, allowable. Statutory contributions are allowable. Gas reinjection costs, are allowable. So for details, I will refer you to the first, part of the tax, Nigerian tax bill, taxation of petroleum operations. Let's look at non-allowable deductions. Penalty and gas flare fees, it was a subject of dispute, in the past because of lack of clarity. But now it's in the law that any penalties imposed and fee associated with gas flaring are non-deductible, at least for the hydrocarbon tax. Expenditures on certain information, it's expected that this information is in the public domain or with any UPRC if you want to get a block, rather than you paying for it. But again, the question is whether you can have those information without paying for it. So these are some of the areas that we need to further look into. Financial charges, of course, that's not an upstream reasoning. That is the reason that is not allowed. Overseas expenditures, even though they are incurred, I believe these are going to be allowable under the CIT and not upstream activities. So tax gross up costs are not allowable. If you, for instance, somebody is supposed to pay PAYE and you say, oh, okay, now you don't want him to bear that PAYE, then you pay the tax on behalf of that person and you charge it to your account, it's not going to be allowable. And that's very simple, straightforward. bonuses and fees for renewing, licenses, and that is, or for assigning rights, to other parties are non-deductible. Custom duties, all custom duties, paid, are not liable because not upstream activity. One of the mindset we should have is that it's not as if some of these expenses are not liable, but because they are not really upstream activities. Excess cost, costs that exceed the cost of cost pricing ratio is not liable. We know that there is this concept of cost price ratio for which only 65%, of the revenue is the maximum amount of expenses that is allowable. So now that 35% has to be carried forward. This is one of the most difficult aspects of the of this Nigerian tax bill, as well as the PIA carry forward of this challenge. Yes, we have some other countries where this cost price ratio, of course, are applicable. In Norway, they have in Egypt, and even in Africa. But the issue is that their own costs are not escalated like our own. That is one of the major arguments, from here and there. So, but let us see how that goes. Capital allowances is another area that we need to know. I think capital allowances is probably one of the most consistent between the PPTA, PIA, and even hydrocarbon tax, because it's 5 years, and then with 1 year, carry forward. So we have this qualifying capital expenditure. Then we also have amortization period of 5 years, as I said, with 1 year carry forward for that, for those assets. Then the treatment of pre-production cost is also fairly, constant, 5 years amortization of those costs. And additional exploration and then appraisal wells, we know 2 of those appraisal wells, are charged and then are liable. So let's look at the determination of chargeable tax.
In the heart of Nigeria, the skyline is changing. World-class roads, bridges and railways are transforming the way we move. Our taxis are building the foundation for a stronger and more connected future, upgrading our infrastructure one project at a time, from new highways to expanding airports. Every naira you contribute is helping to create job opportunities and to boost economic growth. Taxis are powering essential services like modern hospitals, improved schools, and cutting-edge technology to prepare our children for tomorrow. With investment in green energy, we are creating a more sustainable Nigeria for future generations. This is just the beginning. Together, we are building a prosperous Nigeria, powered by your contribution. Affix the most envisioned gathering in the tax calendar, the 27th Annual Tax Conference 2025, themed Taxation for Development, Policies, Law and Implementation. Lock your spot now and be part of this milestone event. To register, please visit www.citnevent.org/events. Together, we build the future. Every tax you pay is a step towards a brighter and a better tomorrow. May Nigeria work for us.
So let's move to step 4 in determination of the taxable profit as well as the tax. So in determining the chargeable tax, once the chargeable profits are determined by the revenue that I did earlier mention, as well as allowable cost and non-allowable cost, you are mindful of this, you come into your chargeable, profit. Now, the hydrocarbon tax rate is applied, and you have 2 rates in there. Chargeable, profit multiplied by the tax rate, that's what you have. And then you have the hydrocarbon tax to be 15% or 30%, as the case may be. Now, where you are dealing with the petroleum mining lease, which you are already under full production, then your rate is going to be 30%. But where you have petroleum, prospecting lease, so this one is going to be 15%. Where you are prospecting, the difference is between prospecting and mining. So one is 15%, prospecting and mining is 30%, so which we just need to note. So let's move on to the template. This is the template, of the computation, just to simplify it. And we have income, and then you have, which is the gross revenue and the balancing charge. Then you have the total income, and then loss brought forward is also, accounted for. At this point, you have eligible deductible cost, which are already listed after the cost price ratio limit, because you have to limit your cost to the cost price ratio. Then that 5% is going to be carried forward. Then you bring in your production, allowance, as well as total. Then you have your total allowable cost. Then when you deduct all those total allowable costs, you have your chargeable profit, and then upon which you apply your hydrocarbon tax, whether 30% or 15%. But that is not all. Don't forget that you still have CIT of 30%. So, and that is why when people add 30 to 30, then they said it's 60% sometimes. Then again, you also see 45%. That's how they arrive at those 60% or 45%. So when people say, oh, the rate is 45 or the rate is 60%. So let's move on. Now let me explain a little bit of the cost price ratio. I've already mentioned that cost price ratio is a mechanism introduced, by the PIA to limit the total deductible cost, in the computation of hydrocarbon tax. Key aspects are there are certain expenses that cost price ratio is not applicable to. That's what this section is talking about. Rent incur on PML, royalties, these are direct costs. So you don't deduct these, all these are liable 100% before you limit the other one to 65%. Contribution to funds, or scheme approved by the commission is very important. And then production allowances. This is to encourage more production. So that one is not put under cap. So you have carry forward excess, which probably, that 35% you carry forward. So let's go into determination of production allowance, and see the eligibility, of that. So the PIA replaces previous incentives, like the investment tax credit and then investment tax allowance with a production allowance to encourage crude oil production. The key details are eligibility, allowable rate. Now, let me explain this in a layman, way so that we can understand. Before, what Nigeria is incentivizing is efforts. Effort means that you have already spent money, on assets. So we say, yes, we give you 10% of that asset as, as an allowance. However, Nigeria is moving from rewarding effort to rewarding success. Were you able to produce? So now we will base our allowance on the unit of production, rather than on, we don't want to mine the asset you used to produce. It's only when you produce, now we are going to give you, an allowance. So it talks about eligibility. Production allowance are granted, per field for crude oil production by a company in each year, of production. And that is what the law says. So you have allowance rates, so which is lower of 20% of the physical oil price, or 2.5 cent US dollar per barrel, for any volume, lower of the two, whichever is lower when you do, your computations or your calculations. So for new project or leases granted, after the commencement of the act, you have provision for the onshore, we have for shallow water, and then we have for condensate, and then we have the exclusion from CPR, calculation. So all these things are very important for us to consider in our calculation. Let's go to step 7, which is accessible, profit. The act actually outlines the determination of accessible profit for companies engaged in petroleum operations. And the key points are adjusted profit. So an adjusted profit is the accessible profit which is derived by deducting allowable expenses from the gross income of the company. If you look at that template, I'm just explaining it now in literal, in words. So deduction of losses, losses are carried forward, so you have to also deduct your losses. You need to be very mindful of your cost price ratio, which we have discussed, before, into 65% of all costs except those major costs that are directly, for operations. So we then have chargeable profit after deducting that. So after the determination of accessible profit, further deductions are made, for any allowances granted to the company, such as the capital allowances, to arrive at your chargeable profit. And then consolidation of tax purposes under hydrocarbon tax. Now, I will only explain this because of the time, and then we move on. Consolidation of cost, and revenue is actually done on terrain basis. So if we have the onshore, we also have the shallow waters. So the onshore can be consolidated, with onshore, and shallow waters, with shallow waters. So this is the way this consolidation can be done. So for company engaged in petroleum operations are related to crude oil with a single terrain, e.g., onshore or shallow water, cost and revenue are consolidated, across all assets within that terrain to avoid cross subsidization. This means that the company can engage its expenses and income from various fields or licenses in that same terrain, to determine its hydrocarbon tax. So now let's move to where you have somebody is having shallow waters, is also having onshore. So how is it going to be done? It says company operating across multiple terrains, both onshore and shallow water, are required to maintain separate accounts for each terrain. Because you can't consolidate, it's going to lead to cross subsidization, and that has already been corrected by this act. Consolidation of cost and revenue for hydrocarbon tax purposes is permitted only within each specific terrain. Consequently, a company must calculate its hydrocarbon tax liability separately on each terrain, ensuring that cost and revenue from one terrain are not used to offset, other terrain. So, yeah, we will all see the benefit, the challenges. Unlike in the past, you can consolidate all those things under PPT, but under the PIA, so it's not going to work out that way. So apportionment of an inseparable cost. These are now question of details. There are some costs that are joint costs. For instance, you have a CFO that is working on the onshore, is the same CFO that is working on the shallow water. So how do you, apportion the cost? Sometimes you look at the production volume, you look at the labor hours, you look at separable cost, and so that you can now be compliant. That is where the issue of planning comes in. And now we have advanced pricing agreement with the Federal Inland Revenue Service. So whatever you are doing, let the FIRS know that, look, this is what we are going to do. Probably agree. It's going to be 45, 55, onshore, offshore. The two of you sign off. So when you have your cost, you can charge it that way. Then this is going to reduce we going to court. Because at the end of the day, we keep on arguing among ourselves, which I think is, totally avoidable. Now, regulatory compliance. We have to study. There are quite a lot of publications by the FIRS. We need to know that those publications are really not the law. However, they are guide to a greater extent, to the extent that you also believe that, that is what is supposed to be.
The annual tax conference is back, bigger and better. The Chartered Institute of Taxation of Nigeria invites you to be a part of its 27th annual tax conference, starting from May 12th to 16th, 2025, at the Abuja Chambers for Commerce and Industry. This year's theme is focused on taxation for development, policies, law, and implementation. For 5 impactful days bringing together experts and stakeholders in the industry, We'll get to explore critical sub-themes including tax laws and administration, challenges of compliance, tax reforms, and expectations of subnationals' tax practice in Nigeria, balancing professionalism and ethics, tax and stakeholders' expectations, accountability, transparency, and sustainability. The conference promises to be an enriching event, offering intellectually stimulating sessions, groundbreaking information, and liaison. You also get to enjoy social activities like the hospitality evening, where districts showcase their cultural prowess, games and sports, and networking dinner at the gala night. For more information and to register, please visit www.citnevents.org/events.
So all that we have been discussing is actually on the hydrocarbon tax. Now, so we go to PPT, but I'm very mindful of time because PPT is something we've been doing before. So most people are very familiar with that, especially people in the oil and gas. So let's go to step 1 and 2, which is scope of petroleum profit tax, which is the gross revenue under section 9 of the act, and then allowable and non-allowable is basically what I listed then, but the only thing is that there is no reasonability test applied, to this section. Capital allowances under step 3 and 4, basically claimable. Step 5 and 6 is another model. So let's go to step 5 and 6. Please, can you move to, this is the model there for our colleagues who are in the industry and those who really want to learn, about the industry. Details of each line of these items are actually in the narrations. So let's go to comparative summary of hydrocarbon tax as well as PPT. Governing law, we know the two laws are different, PIA Act as well as PPT Act. That is the starting point. So if you are doing tax computation under PIA, you have to focus on PIA. If you are doing under PPT, you need to focus on PPT. You shouldn't be mixing these acts in your applicability. We've said it. PML, for PIA and OML for PPT. But on the long run, PPT is going to fade away because the moment all those contracts expires, PPT is going to end. Now, if you look at the tax rate, it's 15% and 30% hydrocarbon tax, as we explained earlier. But under the PPT, it used to be 65.75% as well as 85%. Scope of income tax. We have them as in section 9 of the PPT, which talk about what is taxable, and then section 65 now of the new the Nigerian tax bill, where we have what is taxable. We also have allowable deductions, each having a little, differences there. Under hydrocarbon tax, there are a lot of things that are not allowable, but they are allowable under the PPT because it's only one tax computation. Some of the other ones are allowable under the CIT. Non-allowable costs are also, listed there. Capital allowances, as I said, is most consistent, over the years, except the limitation or restriction that we have under the PPT. So we also have production allowance is under the PIA. There is no production allowance under PPT. What we have there is a petroleum investment allowance, which is PIA of either 5% or 10%, depending on the location, of the asset. I talked about the cost price ratio before, which is limiting the cost that, is incurred or was incurred on production. CPR is only under PIA, it's not under the PPT. So at the end of the day, you weigh all these things and see what the result is. Consolidation rules is under the PIA, it's not under the PPT. Now, apportionment of cost is also under PIA. It's a huge argument under, PPT before and CIT for those who have, some of these things. And then regulatory bodies is common to both of them. It's the same Federal Inland Revenue Service. So let's go to conclusion and possibly some recommendations. The Economic Stabilization Bill 2024, alongside the provisions of the Petroleum Industry Act, this PIA 2021, and the Petroleum Profit Tax Act, PPTA 2004, and the Deep Offshore Inland Basin Production Sharing Contract of 1999 as amended, represent a significant shift, in the taxation framework for upstream petroleum operations in Nigeria. The bill produces reforms aimed at increasing government revenue, simplifying compliance, and incentivizing incentives in the petroleum sector. So this is the conclusion we can draw. It's arguably, let me put it arguably, because not all of us are going to agree on all these phrases. For instance, if you say it focuses on increasing government revenue. Now, since you have passed the PIA, how many investments have we gotten? Especially somebody who say your tax return is not being filed on an equity basis. So how do I put my money down when somebody else is going to file returns, in respect of the money I'm putting down? So these are some of the challenges in the PIA that just to focus on the technical aspect. So there are some other, aspects, investment issues, that are challenging. We are saying is simplifying compliance. Now, somebody will say, I was filing one tax return before. Now you ask me to file 2 tax returns, and you are telling me in your conclusion that it's now very simple. Are you okay? Are you there? These are some of the questions that people really want to ask. But we are saying, yes, for the academicians, of course, it's going to make the work of academicians much easier because, they are going to have hydrocarbon tax, which is like economic rent tax. They can compare that with whatever they want to compare it. And then CIT also, rather than picking PPT to try to apportion into certain percentage. So we need to look at the 2 sides of the coins and then see, which side are we discussing. There is no really right or wrong answers as to who, but let's see whether the government revenue increases and then the investment also increases. Then that's when we will say it's a win-win situation. On recommendation to our members significantly, let's stay informed and compliant. It's very important. We have to stay ahead of this bill. They shouldn't pass this at the National Assembly before we start discussing. And this is where I personally thank the Institute for projecting, these bills to members to the extent that by the time it's going to be passed, we can do tax computation with maximum ease and with close to 0 error rate. Because what we have discussed today here, I don't expect it to end here. Number 2 is to optimize, possible deductions, and you are aware that this is what is allowable, this is not allowable. So we are definitely going to be almost on the same page with the Federal Inland Revenue Service. Maintain accurate record is very important. We know record is one of the major challenges that we have in Nigeria. Even if you pay tax and you don't have your receipt, except Tax Promax is going to help us now, just like our bank account. When you do your teller and you don't find your teller again, the bank will still let you know what your balance is. Maybe Tax Promax is going to help us, but it's definitely not going to help you in respect of your own documents to prove your costs, to prove your revenue. That's not going to help you. So our colleagues in the industry, we are advised to, advise our clients to keep proper and adequate records. And I said tax planning, companies need to engage tax planning to comply with the law. That is what the tax planning means. And when we say tax planning at the institute level, we mean tax morality, which is being practiced in the advanced environment, as against aggressive tax compliance and then, tax avoidance. People are now, not happy with tax avoidance. For tax avoidance, you have not broken the law. It's okay, fine. But you are looking at loopholes in the law with the aim of paying lesser tax. It's now being, detested in the advanced environment. Maybe National Assembly make, a mistake, and therefore you are capitalizing on that. And then, or you go into aggressive tax avoidance, It's even going to be difficult now with Pillar 2, under the OECD, because all companies now, minimum tax, you have to pay like 15%. So the argument is whether even this 15% is going to be applicable to the special economic zones, free zones under the NEPSA Act or GEPSA Act, the Oil and Gas, Free Zone Act, whether they will still also be, required to pay 15% minimum tax, and again, it's in the tax bill as well. The tax bill has also proposed that 15% for the significant economic interest, special economic zone entities. And so the question is, now people have to weigh their options, whether to jump back to customs territory or still going to remain in the oil and gas, free zone. So these are the planning you need to do, but within the law. Let me keep on repeating consistently that your planning should be within the law to avoid additional tax liability. Because if you have to pay additional tax liability, your cost is going to be escalated. FRS is now applying almost 31.25%, and now it's likely going to be about 32.5%, because MPR is now around 27.5, maybe the last that I checked. So plus spread of 5%, that's about 32.5%. That is a poor planning if you don't plan to comply. So what the Institute is consistently saying is about plan to comply, and that is what it is. So I don't want people to misunderstand this tax planning strategy. So you say companies should engage, tax consultants to assess the impact of CPR, cost price ratio limits, and the revised amortization period, of capital allowances, enabling them to optimize their tax positions. The reform proposed, to be introduced by the Economic Stabilization Bill, combined with existing tax structures under the PIA and PPTA, Deep Offshore Inland Basin Production Sharing Contract, aim to strike a balance between revenue generation to the government and investment incentive for operators. However, successful implementation will depend on clarity in legislation, consistent regulatory enforcement, and effective stakeholder engagements. And this is one of the engagements the Institute has done.
Thank you very much, Alhaji Azeez, for making a very complex issue fairly straightforward.
I will invite Mr. Emmanuel Okon, FCTI from Federal Revenue Service, in particular the Assistant Director in charge of oil and gas. You've heard Alhaji making so many issues and cases on these areas. I want you to now come in from your point of experience. You are always in the field in Federal Revenue Service, and how do you see these other areas from administrative standpoint? Over to you, Mr. Emmanuel Okon.
As this has rightly said, there are a lot of grandfathering provisions for PPT and the hydrocarbon tax under Chapter 4 of the PIA, and then the Deep Offshore and Inland Basin Production Sharing Contract Act. However, there are one or two areas I would like to shed more light with respect to the intentions of the bill from our own perspective. From our own perspective is we just want to simplify the entire tax processes. But whether this particular document simplifies it is left for the petitioners to decide, and as we move on, because from the onset of the PIA and the PPTA at tax authorities level is a bit complex and a bit difficult for us, because we just have to know the old PPT very well and also know hydrocarbon tax and Deep Offshore and Inland Basin Production Sharing Contract Act. Now, having said that, there are some areas I would like to come in under that Chapter 3, because beside those Chapter 3s, there are schedules that are tied to that Chapter 3s, right? So, for instance, we have the first schedule that has to deal with capital allowance. You have Part 1 of that schedule, or the first schedule. You have Part 2, and you have Part 3. And then we have the 6th schedule that deals with production allowance, cost price ratio, and then the 7th schedule, particularly which I want to speak to, is also tied to that Part 3, Chapter 3 of the Nigerian tax bill. So there are relevant schedules tied to that chapter. But before even speaking to the schedule, let me start with the cost consolidation, right? The concept of the cost consolidation is only on terrain basis with respect to the income tax computation of the dual tax. So it's not on terrain basis for hydrocarbon tax. So hydrocarbon tax consolidation is in line with the rate for that particular OMN, not on terrain. So if you are in onshore, and then you have a PML that is 15%, and then you have, a PML that is 30%, and you have a PPL that is 15%, you cannot consolidate even though you are in onshore because the rates are different. Yeah. However, if you have a PML of 15% and a PPL of 30%, PML of 30%, PPL of 15%, you can consolidate the SITA irrespective of the terrain because the rate is the same 30%. So we just need to get that rate. So the consolidation is not strictly on terrain basis. It's tied to the rates. So for SITA is a common base. So if you go to section 70, I think it's section 76 of that Nigerian tax bill, you'll see where the issue of cost consolidation was being discussed. The first paragraph of that was dealing with income tax, for which I'm still going to add to it because this presentation did not, to some extent, speak much about the income tax aspect of the dual tax regime, and I understand the time limit, right? So the income tax is the area to which we consolidate because the bases are the same, but for the hydrocarbon tax, because you have two rates, and the rates are tied to different licenses that you hold, you can only consolidate along the rate that you have. And then another good thing that the bill has also tried to do is the fact that if you go to section 264 of the Petroleum Industry Act, right? Recall as Mr. Aziz rightly said, the whole of chapter 4 of the PIA has not been repealed, but it was deleted and taken to the Nigerian tax bill, right? Now, if you go to section 264 of that particular section, the royalty there was royalty incurred and paid before it can be allowed for tax purposes, right? But in practice, we have come to understand that, look, companies are not practicing a cash basis, right? So it's difficult for you to insist on royalty incurred and paid. So but what this NTB has done is to take away that word paid. So royalty incurred now is an allowable deduction under the NTB, right? And then again, the other one is on the issue of the capital allowance I just needed to add. Yes, the capital allowance now is 20% on a straight line for 5 years. But you're going to keep 1%. That 1% is not going to reduce or increase the value of your qualifying capital expenditure. It's just going to be for statistical purposes. Unlike before now, the 5th year was supposed to be 19%, and then you keep that 1% that was supposed to impact on your capital allowance. So under the new law here, you take your 20%, but you need to put an historical 1% of the value in your book, right? It's not going to reduce or increase or impact on the value of your QC. So we have to note that as one of the changes that the law has also bring on board. Then the other one I needed to add was on the case of production allowance. And to me, if my own personal opinion, I think allowances should be simplified. Determination of allowances should be as simple as straight line of 20% annual allowance of applying a percentage to the value, right? So the only input I want to make around the production allowance is the fact that the production allowance for existing license holders, we have to note this because it's very important. For existing license holder, the production allowance is on lease basis. It is only for new entrants, and new entrants are those that got their license after the passage of the Petroleum Industry Act. If you get your license after the passage of the Petroleum Industry Act, your production allowance is on field by field basis. That's the difference. So for existing guys that converted is on lease basis. And then for the new entrant guys is on field by field basis. Another point to note is that production allowance is not applicable to companies under the deep offshore, under the PIA. Yeah. It's just strictly for companies onshore and shallow water and their hydrocarbon factories. So that is what we have for production allowance. And then there's also frontier acreages that is yet to be classified. So the rate can either be 15% or 30%, pending when it is being classified, right? Again, the royalty aspect of it, I would like to also speak briefly because it's one of the area of strong contention. If you go to the 7th schedule, I think it's in the 7th schedule of this new law, because FRS will now be administering the royalty. So we have royalty by production and royalty by price. So one of the changes you could notice, particularly on royalty by price, is the fact that in 2019, when we have the deep offshore and inland basin production sharing contract amendments, that amendment introduced royalty by price to start from above $20, right? So that windfall royalty will kick off. However, during the PIA, that was further increased to from $50 and above. Above $50, you have royalty by price. So what we have now in the Nigerian tax bill is to turn it back to royalty by price, kicking in from above $20, right? So those are some of the few changes. And again, if you also listen to the presentation from Alhaji Aziz, you notice that issues around administration was not mentioned here because that would impact in another bill completely. Issue around filing, the penalties on filing, and the need for you to plan your tax. And I would like to also add this, that FRS, we're not too scared of tax planning per se, right? And I like his last comment towards his concluding part. We're only mindful of the fact that there's a thin blur line between aggressive tax planning and tax evasion. It's a very thin line between of them, even though they said one is legal and the other one is illegal. We're mindful of the fact that there's a level of aggressive tax planning you will go into, you're already in the realm of tax evasion. Yeah. Right. And so that's just what we're mindful, but we're not scared of tax planning. As a matter of fact, part of our policy is to encourage voluntary compliance and also educate the taxpayer on how to pay their tax properly and rightly.
I'll quickly invite Mrs. Oluremi Olubamiwo, who is also, an operator in this field. Madam, we would like to hear from you your view on both the largest paper and Mr. Emmanuel Okon's comment from the administrative perspective. Over to you, Madam.
In the heart of Nigeria, the skyline is changing. World-class roads, bridges and railways are transforming the way we move. Our taxis are building the foundation for a stronger and more connected future, upgrading our infrastructure one project at a time, from new highways to expanding airports. Every naira you contribute is helping to create job opportunities and to boost economic growth. Taxis are powering essential services like modern hospitals, improved schools, and cutting-edge technology to prepare our children for tomorrow. With investment in green energy, we are creating a more sustainable Nigeria for future generations. This is just the beginning. Together, we are building a prosperous Nigeria, powered by your contribution. Affix the most envisioned gathering in the tax calendar, the 27th Annual Tax Conference 2025, themed Taxation for Development, Policies, Law and Implementation. Lock your spot now and be part of this milestone event. To register, please visit www.citnevent.org/events. Together, we build the future. Every tax you pay is a step towards a brighter and a better tomorrow. May Nigeria work for us.
My take home will be Alhaji's recommendation. The fact that we have to stay informed and compliant, and the fact that we have to on our tax planning strategies. Yes, I hear you, Emmanuel, that there's a very thin line between tax planning and evasion, but then the whole idea is more for tax planning strategies, and that's what we in oil and gas, that's what we have all tried to do in the past few years. Yes, we realize the penalties are steep nowadays, and with all the tax audit and tax investigation, So yes, it's tax planning for us, not so much as evasion. Yes, we do understand the thin line in between the two. Like I said, my take home is more for us here, the need to stay informed and compliant to ensure we align with the new provision as well as tax strategies. There's a bit of, to understand this very well, there's a very confusing part here. On one hand, the government is trying to attract foreign investment and simplify the tax structure. I like it when Alaji said, in his conclusion that it is arguable. Indeed, it is arguable because while they're trying to simplify the tax structure, then you have the tax rates, which is between 15 and 30. You have the allowable deductions, the non-allowable deductions. Then you now talk about cost price ratio, the CPR. At the end of the day, for us that we are already in the region of 85% tax structure, it's more likely that that is going to be increased at the end of the day, because you have 30% HCT, you have CIT to pay, then a lot of the items expenses that we have been able to classify as allowable deductions, they're going to be taken away. Now it's going to be restricted. Now you're going to have 65% excess cost and things like that. So it's very imperative for us in CITN that we familiarize ourselves with all of this. So by the time it becomes law, we are able to, make the best of it. Because there's a bit of confusion here and there, but all the gray areas, we should discuss it more and be able to, interpret it. Yeah, Alaji said something about interpretation earlier on. So it is very, very important. It's good that we have a representative of FRS, amongst us and work together and be able to interpret all of this properly before this bill is passed. That's my comment. Thank you.
Without wasting too much of our time, I'll quickly call Mr. Eson Olumide, who have a lot of clients in this industry and who have given a lot of tax advisory in this operation of oil and gas. Mr. Olumide, over to you. Your contributions to Alaji's paper and your response to our people from FRS. Over to you, sir.
Well, I think the industry has gone through phases of change in the past years, and so has been the landscape for tax, not just in Nigeria, but in the global environment as well. So Alaji, Aziz, and Emmanuel have made my job really very easy this morning because they've said so much that I would have said. But having said that, I wanted to comment on a couple of things. The national tax bills deliberately has not made changes to the upstream tax legislation because it was generally felt that the PIA was only passed in 2021, and you do not want to give investors very wrong signals that fiscal space in Nigeria is very uncertain. So too soon to start to effect changes to an act that was barely 3 years when the whole chain of events leading to the fiscal reform bills was set in motion. My expectation in that space is after all this dust is settled and these bills get enacted into law and signed by the president, There will be a separate feature in the future that would look at the petroleum taxes, including the deep water, PSC, the PPT, and the PIA, comprising both hydrocarbon tax and companies income tax. But having said that, we've seen some positive changes or changes generally that has come with the national tax bills. I can speak to, at least 9 of them that have divided into the more impactful ones, the administrative changes, and what the others, the ones I classify as others. So talking about the impactful one, Emmanuel, while remarking the other time, did mention the fact that the 1% tax return value that used to be locked in can now be released. So, just to give an idea of what this means, if you have a big company that's got, $10 billion in capital expenditure, the company will have been forced to keep $100 million in its books. So now you can claim full capital allowance at 85% on that $100 million. And that is really, that's significant. I mean, even if your CapEx original cost for original basis for capital allowance was 1 billion, it's $10 million that's being released here. So that it's really very impactful change that we've seen that's come through the tax bills. Now, I haven't said that no substantive work was done on upstream. There have been, some positive changes. Positive only because they've said they're not going to look at the upstream tax as part of this round of reviews. The other very important one has to do with business restructuring. Under Section 17 of the PPT, the rules are really so tight that if you have unutilized capital allowances or utilized losses, and you're doing a group restructuring, moving from one entity within the group to another, the unutilized capital allowances and also unutilized losses are almost trapped. As that has been the hardline position taken by the FRS and Mr. Okon. But now, by virtue of these tax bills, we all have agreed, that the best thing is to actually, because we want to promote restructuring, we want to promote deals in the industry. So now companies are able, if they do group restructuring, are able to move over any unutilized capital allowance from company A to company B, and same with any tax loss that is unutilized from company A to company B. Now, there is a third one, which is not directly impacting the producing companies, but which is of very great importance as well. These companies rely on service companies to run their operations. The big service companies who all operate in Nigeria. Either to now, they follow these rules in CETA that you pay tax in the currency of transaction. But for the first time now, we have in this national tax bill, gives flexibility to these companies to pay their taxes in Naira. So they will be less under pressure to go and be sourcing for FX where they do not have to do. If they are comfortable and they've got Naira, they go ahead and pay their taxes in Naira. So for me, these three are really significantly positive. The 1% TWDV that Titato was trapped, business restructuring, and the optionality for these service companies to pay their taxes in Naira. If I look at the administrative changes that's coming through the bill, one is the fact that, upstream companies now have to file royalty returns, okay? They need to file royalty returns, monthly and annually. That is one. The second one is the companies in the upstream that produce and sell gas now need to file estimated returns for their gas upstream income and also pay estimated taxes on those gas income on a monthly basis, just the same way they do for their oil production. And then, of course, for midstream companies like LNG specifically, they also now need to start paying estimated taxes on their gas income. So they file and also they pay on a monthly basis. So these are three key administrative changes, bordering on midstream LNG, upstream gas producers, and also royalty payments. If I just talk about the other ones, one is about license to operate. So tax has now become a critical license to operate. On the basis of default, license to operate could be withdrawn by any PLC if an upstream company falls short in its obligation for taxes. And that is really something that operators must know. If FRS decides to invoke that, it will be a problem if a company is defaulting in taxes. The second one is, as part of this general reform, we all agree that there is multiplicity of taxes in Nigeria. 2 years ago, if I remember correctly, I was at the OPTS tax event in Rotterdam, where I made a presentation on multiplicity of taxes, and I know that I did compile 40 different taxes that is paid by operators in the industry, 40 different taxes. One of the things the reform is bringing to bear is that all these taxes will be rolled into not more than 9. And that is really very significant because, with these 40 taxes, you just don't have to think about these taxes, as just payment of taxes. No, it comes with, House of Reps summoning them for alleged default in one of these taxes, Senate calling the CEOs and CFOs. It comes so much administrative burden to these companies, that it distracts the management of the industry. May I just mention that in other oil provinces and gas provinces around the world, the biggest risk that operators face is what we call underground risk or technical risk. Some people call it subsurface risk. This basic kind of risk is dealing with, am I sure the reservoir is as good as I say it is? Would I actually meet the initial stock of oil in place as I thought it would be? Is the geology the way I saw it in the seismic? That is what keeps operators busy. That is what takes the time of management. They spend less time on what we call above ground risk, or what some other people call non-technical risk. In the last 20 years, the reverse has been the case in Nigeria. The average senior management of these oil companies are dealing with non-technical risk in Nigeria. One agency is summoning them, House of Rep is summoning them. Today, earlier today, with one of the big oils, and the CFO I met with said, Olumide, I almost changed the time of this meeting because we've been summoned by the National Assembly to come and defend allegations against us on TET fund. This is what keeps management of these oil companies away, and that is why they cannot increase production. That is added to the fact that Nigeria is a country that already deals with other structural issues in the oil industry, including the cost premium. This country, unlike other oil-producing countries, has a 40% cost premium on the cost of production. Whatever it will cost you $1 to produce elsewhere, it will cost you $1.40 to produce in Nigeria. That automatically makes us not competitive. And that is why you will see that government is trying to do what they can do to still make the industry work, because this is one industry that does not thrive on sentiment. Decision on, as far as this industry is concerned, is purely economics. That's what it is. And that is why if you have issues around structure, around insecurity, around political stability, you have to compensate some other ways. That is why you have to give incentives. You saw the presidential orders last year burden on NAG, associated gas incentives for onshore and shallow water, and also later on dedicated incentives for deep water gas and deep water oil, which the operators still say is not enough. Madam was saying the other time that PIA will herald in more taxes for them, and then they're already paying 85%. I mean, I told a lot of clients that, look, don't make sentimental decisions. Run your economics. If PPTA and Petroleum Act regime gives you better net present value of your assets and net better internal rate of return, please stick to it. Don't bother to change to PIA. But if you think that going to a 30 plus 30 regime, 60%, but losing benefit of items that either were deductible and no longer deductible, if the economics proves to be better under PIA, just move on. I mean, I know that it's not just about the tax rate. If you cut to PIA, you're likely to lose some of your acreages. You might lose as much as 60% of your acreages, depending on how much you are exploiting those acreages. If they don't fall into the 5 categories specified by the PIA, either a field in respect of which you're conducting additional appraisal, a field in respect of which you have significant gas discovery, a field in respect of which you have material oil discovery, a field in respect of which you are doing development activities, or a field where you are currently producing, you will forfeit the field under PIA. And that's why, when you're doing economics, you need to do a full economics to decide whether you want to stick with PPTA or you want to stick with PIA, at least until when your current license expires. Now, for me, we need to join the wagon of progressive taxation as a country. I think the national tax bill is in line with this. It's generally a pro-business bill, even though there may be concerns around 1 or 2 items. And that would make me to now go back to where I started from. I was trying to list my own 9 items that I think is worthy of call out here. I've talked about the more impactful one. I've talked about the administrative one. And then I started talking about the other ones, which I talked about license to operate issues, significant reduction in number of taxes and levies that would apply. And then, the one that is, I know it's not well received is the capital gains tax one, okay? Because everybody is used to paying capital gains tax at 10%. And this is an industry that is famous for deals. So many deals. Some of them you are aware of, a lot of deals going on. Suddenly having that rate move up from 10% to 30%, of course, wasn't really, was making a lot of operators uncomfortable. I mean, it's bad, but maybe what just to mention here is, when I looked at this, I could say that typically when you make disposals, you suffer 2 types of taxes. You suffer income tax, which is done by way of balancing adjustment, and then you also suffer capital gains tax. And this clawback that you do under PPT, and the balance and the capital gains that you declare, they don't overlap. Okay, so when you look at the value of what you sell, you see that more than 80% of the taxes you are paying back is under income tax. It's under PPT that you are paying 85% back. Or if you are under PIA, maybe you are paying 60% back. So the portion of that profit that is really then gets subject to capital gains tax is almost like 20% on the average. So, So maybe we need to look at some things that are positive about this whole thing, this whole reform bills, and also those that we can advocate. The good thing is that every citizen of Nigeria, every organization in Nigeria, and every coalition in Nigeria have got the right of submission. There will still be a public hearing. And if people have concern about certain aspects of the bill, they need to make the submission to the National Assembly. The House of Reps will do theirs, the Senate will do theirs. Together, we can promote compliance, because what Nigeria needs right now are law-abiding citizens who comply and pay their taxes. And I believe that is what CITN stands for. Sometimes ignorance makes people to default in their taxes, and that is why we are having this sort of series in our institute to let everyone be aware of what is expected of them. Ignorance is not an excuse under the law. So I believe that the operators need to also reinvent themselves, get used to this new thing that is coming. The way forward, I don't know what the future of Pillar 2 will be, with Donald Trump, but whatever it is, I think we'll be having the engagement. But there are 1 or 2 things we can learn from Donald Trump. I suggested to my colleague the other day that maybe Nigeria should consider renaming Gulf of Guinea Gulf of Nigeria, and Bight of Benin, Bight of Nigeria as well. I think let's copy 1 or 2 things that we can copy as well. But regardless, I think there's a lot of work to be done. This bill, as we know them, will still change. Maybe not materially. I agree with Assis on that, because the National Assembly has got the right to change the laws, and people will make submissions to them, which they will change.
Okay, so we only have just one question on the chat box. The person is asking, what is the impact of taxation of income that will contribute to the economy? I think that is generic. And you're also asking, how does the bill address issues of multiple taxation for multinational companies? So I will still leave that to Alaji to attend to. And I'm fully aware that at some point, you may need to move from PPT to PIA. Now, if this bill is passed into law, Alaji, is there any provision taking care of those operating under PPT? That is my question. And what is the way forward if they are not provided for and they must still be in business?
Thanks very much. I will just say, very briefly, and then the three can also comment. Especially, let me start with the last question, which Dr. Ayodeji did mention. If you check the provision of the PIA there, there is a provision for conversion from PPT to PIA. However, the government is very mindful of its stabilization of fiscal, let me call it fiscal, stabilization clause or position that it must maintain. For instance, just as Olumide rightly said, it's about looking at your economic model. You have to look at your economic model. But before we come to that economic model, is the provision of the law. Now, is the law forcing everyone to convert? The answer is no. There are certain people that must convert, by February, last year, 2023 or thereabouts. There are some that has to, convert the marginal fields and all those kind of, set of people. They have to convert, and I think that has been done now under PIA. However, for those that are given options, of conversion, or those who have a OML, and these OML are on certain terms, with the government. So government is not trying to breach that, agreement, or understanding or the conditions of award. So they are given options. Now, when you now go economic model and you do your competition just as Madam Remy had said. Now, if you do your competition and you see that under PPT will pay you rather than moving to PIA, so the best thing for you is to stay under PPT. Yeah. So the best thing is actually to stay under, the PPT, as Olumide had said, because it won't pay you to go to PIA. Now, some of those things that will make it not to pay you, he mentioned. Number one, your acreage might be reduced because the acreage under PIA is, smaller to that under PPT. But and that is why when you are reading the acts, you are reading this Nigerian tax bill, you see that it's going to refer you to some provisions of the PIA. What that means is that go and look at your acreage there and put it in your economic model. So where you have maybe 25, square kilometers, and it's now saying 20 square kilometers, what is in that 5 square kilometers is huge resources that you probably will be losing. If you are looking at, 30 plus 30, and then, I look at the 30%, whatever rate. So you need to put that in your economic model. You also need to look at, yes, the rate has, patently, can be seen to have reduced from 85 to 60% or 45%. That's not absolute. Your economic model is going to show that, look, by the time you have your same revenue, under HT and then the PPT, and you are claiming all your costs under PPT. Meanwhile, under PIA, you are restricted to 65% of your cost. You are not able to claim 35%. So it's only the economic model at the end, when you look at your tax and you remove it from your profit, accounting profit, you see what your net profit is. Then that you can then decide whether you are going to convert or you are not going to convert, where you have the option. So I think the two of them or even the three of them can make additional comment on that, because it's a choice that needs to be well evaluated before you move. Now, if you now see that PPT pays you, the best thing is for you to keep your OML. And that is why we have in the Nigerian tax bill, that after the hydrocarbon tax, part 1, you have part 2, petroleum profit. So the government is still putting that there. That if you don't want to convert, that's fine, but it's going to expire. So by the time it now expires, you now don't have option other than to go back to PIA. And everybody now is then going to be under hydrocarbon tax, going forward. But they're not going to distort your existing, license that is given to you, including the PPT. I think this is one of the areas that Olumide, did mention the good things, about the act. It's not everything that we will say, oh, this one is not okay. No, we have to mention those things that are good and those things that are challenges, that may be challenges for the country. It's not about any individual, So I think that's one. Grandfathering, which Mr. Okom mentioned, about grandfathering, still putting that PPT Act there is one of the good things that has happened to the Act. So I think I cannot exhaust that. I would want them to also add to that. Now, in terms of the impact on the revenue of the government, well, again, also that is also debatable. The measurement, I remember when we were looking at this from the CITN perspective, is that the PIA itself, as well as the Nigerian tax bill, when passed, it's now become an act. A way we can measure it is by looking at, the contribution of the act to the revenue of the government in terms of new investments. Because the existing investment and the existing revenue, for instance, if the Federal Inland Revenue Service is now like enforcing the area of penalties and interest and is giving more revenue from the existing business, that is really not an impact of any law. It's more about the efficiency and effectiveness of the FRS under the existing law. So the way we can measure the PIA, and then the Nigerian Tax Act, when it becomes an act, is really how many investments do we have in the industry in terms of investment in USD, how many more rigs do we have from these existing rigs, which are new? How many new wells, apart from, trying to work on the existing fields? So I think these are the measurements of whether we are having more revenue, to the government. And I remember at our extractive industry unit, which we work under the coordinating then, was to look at this thing from 3 perspectives. Number 1 is that we have an increase in the production, which is going to be increase in the revenue to the government. Is that we remain static at this level because no new people probably are coming in. And the third one is that the production is going down, or the number of assets will remain static and some will, outlive and then expires. When it expires and we don't have a new people, coming in. And so these 3 positions are going to help the government in really looking at this law. Because we will not be asking ourselves questions that, okay, we have a new law, so why are we not having new investors? Then people like Madam Remy can now be called to come and present in full what are the investors looking at. I mean, of course, they are not forcing the government to do anything, but look, for instance, I mentioned the equity way of filing returns, as against the economic basis of filing, tax returns that we used to do in the past. And, but now the law has changed that. How does that impact? The CPR, is this something that is improving the economic model of tax? So we can then look at it from that perspective. So I think there are more issues in terms of analyzing, and that impacts on the revenue. So I think these are the 2 of those 3 questions I want to comment on. I think others can add to it, and then we can then move on. But I must thank those the panelists for their great job. Thanks.
Thank you very much, Alaji. And I will call on Mr. Emmanuel Kun. Mr. Olumide can also put his view, and Mrs. Olubami Mowo can go ahead. But let me quickly add this question so that Mr. Okun can take it up and will flow in that direction. Someone wants to know, how does this bill address issues related to profit repatriations of foreign oil companies? I'll take it again. How does the bill address issues related to profit repatriation of foreign oil company? I will appreciate Mr. Okun to pick up this one in addition to the first one responded to by Alaji. We'll flow to Mr. Olumide, then we'll end it Mrs. Olubamimowo. You can as well do your parting shot at the same time. Thank you.
Thank you, Mr. DG, and thank you, Laji Aziz, for that great commentary again. And I think the section is becoming very, very interesting and also quite insightful. I will start from the comment around having hydrocarbon tax and PPT, which Mr. Aziz and I think Mr. Olumide has given one or two insight into it. But I think I just need to make this clarification that, as Aziz rightly said, the conversion to PIA is partly voluntary and partly compulsory. So the question is that who are those that will convert compulsorily, right? Under Section 94 of the previous Petroleum Industry Act, or the current Petroleum Industry Act, sorry, if you're holding a marginal field license, your conversion is compulsory.
Correct.
You must convert to the PIA. If you're not holding a marginal field, you have an oil block, you can voluntarily convert under Section 92 of the PIA. So you have that voluntary conversion. Now, between the Section 92 and Section 94, there are conditions and there are deadlines for the conversion. So it's not endless. It's 18 months from the passage of the PIA that you have that window to convert voluntarily. And the 18-month lapsed on the 16th of February
2023.
2023. That was when the 18-month lapsed. There's an exception. I'm going to come to that. Then for the marginal field operators, theirs was compulsory for them to convert. And the reason was because government was to translate their marginal field into a PML, to give them a PML now, making them to hold a PML licenses.
Yeah.
Right? Theirs was compulsory for them to convert. So, and then for you to be taxed under hydrocarbon tax, you must be holding either a PPL or a PML. If you are holding an OML or OPL, you still be taxed under PPTA and Deep Offshore and Inland Basin Production Sharing Contract Act. So the kind of license you hold also determine where you will be taxed. You cannot hold an OML and think you'll be taxed under hydrocarbon tax. No. It's under PPTA or Deep Offshore and Inland Basin Production Sharing Contract Act. Now, the only window left now for anybody that want to come into the PIA is under Section 65. That has to do with IJVC with NNPC. If you want to go into incorporated joint venture, that window is open. At any point in time, the law says NNPC can voluntarily enter into an IJVC with any of its partners, and the terms of the PIA shall apply to that arrangement. So that's the only window left now, right? So even though in the NTB, you see petroleum profit tax, you see hydrocarbon tax, you see Deep Offshore and Inland Basin Production Sharing Contract Act, is tied to the kind of licenses you're holding. And I agree 100% with Mr. Olumide. You have to run your economics and see whether you want to convert or not. So your economics is what will guide you. And so far, so good. And to be honest, from 16th of August 2021, when this law was, when the bill or PIA bill was passed into law, the appetite for conversion is not as it was being anticipated. In short, in our last engagement with IMF, I think what we noticed that it was almost between 37 to 40% of the industry that actually converted. So almost 60% is still outside the basket of the PIA. So we just have to get this record straight. Then for foreign repatriation of companies' profit, which the last person just asked, and I want to start from one or two amendments that have taken place under the PPTA The first one was the 2019 Finance Act. The petroleum profit tax we used to handle commenced far back in 1958 and is one of the least amended income tax law in this country. Right? There used to be a section under Section 60 where profit from your petroleum profit tax was exempted from further taxes in view of withholding tax. I don't know if you can still recall that, right? So what that amendment did was to, number one, delete that particular provisions and put everybody in the same pedestal, right? Such that whatever profit that is being distributed, whether you are in upstream oil and gas business, the profit will be subject to withholding tax in the hands of shareholders, right? Again, if an investor is coming to your, the way the oil and gas industry works, if an investor is coming to your terrain, to your country to come and invest, at the bottom line is, what is the return on my investment, right? And so the way fiscal regimes are being designed is not really designed to a kind of locked up the investor. No, it's designed to the extent that the government, the host country government should be able to also have a share of whatever profit you're making from the resources you're extracting from that host nation. So you're not supposed to make a law that will tighten up the investors so tight that it doesn't know how to even pull out his profit. No, your law shouldn't go around that. And then recall again, between the 20 years that Alhaji Aziz rightly mentioned that it took us to bring up the PIA, 20 years. Within that 20 years, we lost so many ground that we were priding ourselves as number one in Africa. We lost it to Angola. And then there were also discoveries within countries that were close to us. They were discovery in Ghana, they were discovery in Senegal, they were discovery of crude oil deposit in Namibia, in Tanzania, and even in Nigeria here, there was discovery of crude oil. So it doesn't mean that when you're designing your fiscal just have to be competitive. You just have to know that you're not the only person in business. Your fiscal must be competitive to be such that it can also attract investors. And I like what the Olumide team did on with respect to greenfield development, which they come up with some good incentive. I actually supported that, and I also like the fact that the Fiscal Reform Committee acknowledges that particular executive order and incorporated into the national tax bill. I think if you go to section 76 or 75 thereabout, if I'm not mistaken, you see the NAC field was brought into, section 85. The NAC field was brought into the Nigerian tax. So the whole essence is just for you to be able to extract these resources and have a fiscal regime that is competitive, not making laws that will eventually discourage investors. So I will stop from here, and then the other discussion can also contribute. Thank you.
Yeah. Thanks.
Thank you very much. Mr. Olumide, over to you, sir.
Let me just add that, one of the statements he made was, while PIB was in hiatus, the 20 years that PIB was in hiatus, if you take just 2015 to 2019 alone, between 2015 and 2019, $75 billion was invested in Africa, oil and gas. Nigeria got 4%. 4% of 75 billion. That was 3 billion out of 75 because of the reaction of investors to fiscal uncertainty. Investors, if their primary concern is to guarantee safe return of their capital and also their returns. If we say there is a bill that is in National Assembly forever, nobody wants to put money down because they don't know what exactly it will mean. If you contrast that with what happened last year, after the PIB was passed in 2021, the last year, a raft of presidential orders granted some incentives. We had two major FIDs. Total Energies took the FID on Roberta Field, about $550 million, and Bonga and Shell took FID on Shell and Partners took FID on Bonga North, which is well over $5 billion. If the fiscal certainty is there, investors will come. Like I said, they don't run on sentiment, they don't run with emotions. It's wherever the returns is, that's where they allocate capital. The industry is not for church boys, it's for cowboys. They only go after money. FRS understands this very much. And FRS, like, Emmanuel mentioned, have been supportive because I remember, Emmanuel, if you remember, I think about 2 years ago, I made a presentation at your annual retreat and I contrasted how much you made from the oil and gas industry. I think that year you made equivalent of $5 billion if converted at the prevailing exchange rate. And I compared it with what you made, that was 2021, right? I compared with what you made a decade earlier, 2011. You made $20 billion in collection from the oil industry. The fortune of FRS follows the fortune of the industry. So if there is no uncertainty, if there is uncertainty and people are not investing in the industry, you will see it. I think either you or, as is mentioned, recount. These are factually incontrovertible evidence. If the industry is thriving, recount will increase. Production will increase. At least, I mean, thankfully, since we are now, they're about 1.8, 1.9, so which, including condensate, meaning we are making some progress, but it must be sustained. Investors want certainty. They want certainty in the fiscal space. They want to be sure that if you tell them, and you can understand them, when they come to commit money, if what they were doing was investing in the aircraft, the day you change your tax laws adversely, they will just fly their plane away, right? If it was a ship, they will sail away. But these guys commit $5 billion, $10 billion for something that is under the ground. Where are they going to go if you suddenly change the rules? And that is why for them, certainty is ultimate. They need to know you're not going to change the rule. And that is why when they sign contracts, government still needs a lot to do to build trust. Right now, there is still trust deficit. And that is why each time they sign contract with Nigerian government, they put so much belt and braces there that Emmanuel Okon's team don't like it. They will put so much fiscal stability clauses there to ensure that if somebody wakes up tomorrow and start to change the rules, they are protected. When we woke up one day and started to introduce dividend withholding tax into the oil industry, the protection clause with NNPC already covered it, so they're getting their money back. When we woke up one day and changed the royalty rates, they put the fiscal stability clause. I mean, I'm not saying it's peculiar to Nigeria. Typically, wherever they go, because they're making long-term investment, they always ask for fiscal stability clauses. Although a lot of countries have moved now away from fiscal to economic stability clauses to say what we guarantee is that will make you whole economically. So tax laws may be changing adversely, but there may be investment climate that is positive that neutralizes that. So for me, it's a case of Nigeria is a work in progress. The oil industry is a work in progress. I like the increased collaboration between the taxpayers and FRS now, and not because Emmanuel Okon is here, his team. They've always, for me, stood out really because they engage really, and we have our fights and we have our disagreements, and but then we are working towards just one common goal. Nigeria needs to work for all of us, so that we stop rejecting. We will stop receiving rejection of visas when we apply for visas.
Thank you very much, Mr. Olumide. I will quickly move to Mrs. Remy, if she's still there. Mrs. Remy, over to you for your comment on the two questions, contribution from Mr. Olumide, and a bit of your parting shot. But that does not mean you log out of the meeting room. Over to you, madam.
For us in the oil and gas industry, we have lenders, we have foreign lenders that want a stable tax regime. Some of our lending meetings, they go into a year, 2 years, 3 years sometimes. And then when you start a lending project, you start with taxation on, let's say, for instance, 85%. And then in the course of your project, you change it and say, oh no, it's no longer 80%, it's going to be 30, and you start adding to it. We need a stable tax regime. 2 years ago or 3 years ago, it was BIA. Now we're changing it yes, it's being reformed, but that reform sometimes discourages the investors. So it is important that our tax regime is stable. Like you rightly said, he said in the investment, we only got 4%. I got that from you, Mr. Olumide. He said in the investors, investors, we only got 4% in Nigeria. That's very low. We need more than that. Having a stable tax regime gives us more than that, and that's what we should work towards. Is the bill attractive to investors? It's an argument for another day, especially in oil and gas. It's an argument for another day, if this bill is attractive to investors or not. That's my comment. Thank you.
Before we go, I'm just thinking, Alaji, we have freer questions in the course of our program. I think it's because this area is a specialized area. And I was thinking, is it out of place for us to have a mentorship program in this oil and gas taxation, to bring a lot of people to understanding this oil and gas very well, and then venture into it. I'm very sure you'll be happy if you see a lot of people venturing into this. I'm just thinking, Alaji, over to you, sir.
Very well. Thank you very much. I will be available, at any time that we need to have programs like that. It's my area of interest, so that we have quite a lot of Nigerians who understand, this industry very well. Just as Olumide, gave us some figures. For me, it's not quite pleasing where Nigeria is right now. In year 2000, we are talking about 40 billion barrels of crude oil. In year 2024, we are talking about 36.8 billion barrels still underground, proven reserves. And so we've done only 3.2. So if we had done like 10, billion barrels, it will have impacted on the life of Nigerians. All the money we are borrowing from outside, we probably won't be borrowing, and we definitely probably not will be doing debt servicing and all those kind of things. So it's only when Nigerians know what we are losing by not getting investors to bring these things out of the ground, then that we can be on the same page. And I align with Mr. Olumide in terms of what Mr. Okon is trying to do and the new thinking in the FRS, that look, okay, we think is now time to be on the same page so that Nigeria can be, ahead of Angola. For example, we are now struggling with Angola, which is not supposed to be at all. It's because of our fiscal regime. So if we have many Nigerians, many CITN members who understand this industry, both at the FRS, practitioners, and the industry, like as Remy was saying, we will all be on the same page and come up with acceptable fiscal schemes that is going to be very helpful for this country to move forward. I am very pleased and passionate to be part of that at any time, at any day. Thanks.